Hello everyone, welcome to Learning Sessions. I'm Himanshi Malik and today we are going to do AFM Chapter 1 Important Questions. And if you're preparing for JAIIB, then you should check out our Learning Session IBF exam app that is available both on Android and iOS. Now, in this app, you can find any courses on JIIB, CAIB, and if other certification courses you are interested in. And the speciality about these courses is that we're going to provide you full chapter wise videos, PDF notes, full question and question videos also. So this can help you in preparing well for your course. And for regular updates on our upcoming videos, you can also join our Telegram channel, IIBF Learning Center, and it can be very helpful for you in understanding the latest updates in your courses and the upcoming courses and videos. So do join this channel. So without wasting any time, let's just get into our chapter number 1 questions. So the first question that we have is from chapter 1, definition, scope and accounting standards including Ind AS. So first of all, we should know that there are two type of accounting standard that are prevalent in our country. First is accounting standard and the other one is Ind AS. Okay, so the difference between these two is that accounting standards were established according to India's accounting needs when we started regulating or formalizing our accounting, right? But to meet our accounting levels at the global level, right, we introduced Indias that were converged from Indias. Okay, converged from global accounting standard that are called IFRS, International Financial Reporting Standard, and IAS, International Accounting Standard, that we adopted in India as Ind AS. So these are the two kind of accounting standard that are prevalent in our country. Mostly these two are same except for a few differences. So that's first thing that you should know, and you should be knowing since you have done this chapter, and then we are doing the questions. So let's just get into the question number 1. Which of this statement is correct regarding recording of transaction in accounting? So whenever we are recording a transaction in accounting, they're asking which of the following statement is correct. Number 1, recording business transaction in the accounting records is known as journalizing. Number 2, transactions are recorded in a chronological order to ensure accuracy. Number 3, transactions which are measured in monetary terms are only recorded. And number 4, recording transactions involve grouping similar transactions together into relevant accounts. So, out of these four transactions, let's look at number 1, that recording business transaction in accounting records is known as journalizing. Is that correct? Yes, because the first step in the accounting is called making a journal entry where we take a business transaction and we post it into our books through journal. So, for number 1 is correct. And number 2, the transaction are recorded in chronological order. That is correct, right? What is our basis of recording transaction? We take it by date, that on this particular date this asset was purchased, this payment was made. So we record transaction in a chronological order. So number 2 is also correct. Then we go to number 3, the transactions are measured in monetary terms. Is that correct? That is absolutely correct, because accounting involves recording of only monetary transaction. We do not record non-monetary transactions. So number 3 is also correct. And then we have number 4, that recording transaction involves grouping similar transaction into relevant accounts. So tell me one thing, do we group similar transaction in relevant accounting? Yes, we do. But is that part of the accounting process called recording? No. How does the accounting process work? Let's just look into it. So the first step is recording. And in recording, what we do, we make the journal entry, right? After we have recorded the transaction is posted into the general ledger, which is called grouping of activity into similar accounts. So here they're asking recording transaction involve grouping, then this statement becomes incorrect because recording involve only passing out a journal entry. So for that reason, this statement is incorrect. So out of these four, which statements are correct? Number 1, 2, and 3, and hence our answer is option number B. That statement 1, 2, and 3 are correct. Okay. Now let's look into question number 2. Which of the following transactions are recorded in accounting? Now they have given us four transactions and we have to tell them which transaction is going to be recorded. Now these are very basic question. You should easily be able to answer this, right? First, raw material purchased from Ram worth 1000. So we purchased raw material from Ram. So we purchased an asset into our business. This is a monetary transaction, so we should record this, right? Then we paid wages to the workers. That is also recorded in the books. Goods sold to a customer worth 1500. Will that be recorded? Yes, this is a monetary transaction. We are getting income. This is going to be recorded in our books. However, look at the option number 4, taking a vacation as an employee. Now when our employee take vacation, do we record that in our books? The answer is no. What is going to be the impact of an employee taking vacation in our books? That is going to be after when we pay his wages and we take this into consideration while calculating the wages that we are going to pay him. But is this something that we are going to record in our books that this on this particular day my employee took vacation, so employee debit vacation credit? We don't do that, right? So this option is not correct. So the entries that are going to be recorded are number 1, 2, and 3. So our answer is option number B. Okay. Next. What is the purpose of classifying transaction in accounting process? So whenever we are doing accounting, we classify the transaction. What is the purpose of classifying them? Number 1, to record financial transaction. So in recording, we do journal entry, right? So this is not correct. To prepare a trial balance, to group transaction by date, or to organize transaction into relevant account. So what is the correct answer here? Why do we classify transaction in accounting process? So that we can organize the transaction into relevant account, and at one glance I should be able to see, okay, during this particular month, this was the revenue I made. I will go directly and look at the revenue account rather than going through the journal entry I made for the revenue, right? Or if I want to see how much of wages I paid to my employees on which particular date, I should just go to the wages account and I can see it there. So that is the purpose of classifying transactions, so that I can easily be able to analyze my transaction related to a particular expense, particular income, or asset liability simultaneously, right? So option number D is correct. Now, what is the meaning of ledger posting? So the second step in our accounting process is ledger posting. And what is the meaning of it? Organizing ledger account alphabetically, summarizing financial transaction in balance sheet, transferring transaction detail from journal to appropriate account, or preparing a trial balance at the end of the fiscal year. So which option seems most accurate of these? Option number C, that after we have made a journal entry, we will transfer the details of those transactions to the particular accounts, right? So that we can get a organized view of that particular income, that particular account. Okay. Then we have question number 5. Which steps involve preparing a summary of all ledger account balances, regardless of their debit or credit nature? So, after we have posted entries into our ledger account, the next step is where we summarize the transaction into we kind of prepare a list. And what the list is, why that list is prepared? That list is prepared so that we can see that all debits are equal to credits, which is called our trial balance, right? And in trial balance, we post all the accounts regardless of their debit or credit balance, right? So what is this step called where we prepare the trial balance? Option number 1, recording of transaction. This is where our journal entry comes. Classifying transaction. This is where GL posting come. Summarizing or analysis and interpretation. Now see, analysis and interpretation comes afterward. When we prepared financial statement, we prepared balance sheet, we prepared P&L, and when we analyze and interpret the financial position. But When we prepare trial balance, this process, this step is called summarizing of our financial transactions. Okay, so option number C is correct. Question number 6. Which of the following statements is not prepared for summarizing business transaction? Okay, so to summarize our business transaction, which statement is not used? Trial balance, we summarize in it, right? Then we have balance sheet. Balance sheet is also kind of a summary where we only take assets and liability, and P&L account is also a summary of those accounts which are related to income and expenses, right? All these three statements are summary, right? However, option number D, is journal a summary? No, journal is a very first step where we properly record each and every transaction. So option number D is not a statement prepared for summarizing the business transaction. Then we have question number 7. What is the primary goal of analysis and interpretation in the accounting process? So in the accounting process, the last step that comes is analyzing and interpreting the financial statements so that we can make our future decisions, right? So that's what they're asking, that what is the primary goal of analysis. So let's just say I am a business person, okay, and I'm seeing my balance sheet and P&L at the end of the year. Now, what could be my goal of seeing this? I will see how much profit I made. I will see which of my products are performing well, on which areas I'm spending more, how much are my assets, how much do I owe to other people, right? These are the kind of things that I see. What does it mean? It means that when, as a business owner, I am analyzing my financial statement, I'm looking at two things. Now, what are those two things? Firstly, I'll see profit. Now, what does profit mean in business? It means my financial performance. How well did my business perform? Like when we take exam, our performance comes in result, right? How much marks did we make? In business, what is our result? Our result is profit. So my financial performance, that is my first goal of looking at financials. And my second goal is I want to see where I stand in monetary terms. How much do I own? How much are my assets? And how much do I owe to others? I want to see my financial position. So there are two things that I want to see: my financial performance and my financial position, right? Other than that, what could be the purpose of analysis and interpretation? Yeah, this is the main purpose. Do we prepare financial statement in analysis? No. First we prepare, then we analyze. So this is not correct. And to record financial transaction accurately, when I'm doing analysis, am I recording the transaction? No, that is a very first step, and analysis is the very last step. So this is also not correct. My correct answer is option number C, to gain insights into financial performance and position. Now look into question number 8. Calculating financial ratios and performing trend analysis are related with what? When will I prepare financial ratios? When will I prepare trend analysis? When I am analyzing my financial position, when I'm interpreting my financials, right? Only then I'm going to use financial ratios to see how much profit I made, how much asset do I own as compared to the equity I put in, right? Or how much do I owe versus how much I own, debt equity ratio. So that are the things that I see in analysis and interpretation. Question number 9. Which of these is an objective of accounting? So, what is the objective of accounting? Maintaining systematic records, analyzing earnings and losses, evaluating financial status, or overseeing employees. So, what is our primary purpose of accounting? Overseeing employees is not done through accounting, that is very clear, right? Evaluating the financial statements. Oh, sorry. Then we have maintaining these three options left, right? Maintaining records, analyzing earning and losses, evaluating financial statement. Now, in the above questions, we discussed that when I analyze my financial statements, I do check my earning. I do check my financial status. So that is my goal of accounting in some way, right? But let's just look at a few terms in a detailed manner. So there is one thing called accounting, and then there's another called financial reporting. Okay. So these are two different terms, and they clarify the objective, and they have very different objectives, right? When we talk about accounting, so accounting is mainly done to record transaction in a systematic manner, whereas when we do financial reporting is the part where we prepare our financial statement, we present our financial statement, and we make analysis from that. Okay, so these two are different disciplines that are part of a bigger umbrella, that is the accounting profession, but these are two different terms that we use for these two part and this. So when we talk about the objective of accounting, our correct answer is going to be maintaining of systematic records. Okay, now question number 10, which of these is not a user of accounting information? Option 1, internal user, external user, middle user, or none of the above. Now we've heard about internal users, the people within the organization, and then we have external users, people outside the organization. Internal users can be management, owners, right? These are our internal users, and external users can be banks, creditors. Okay. Now, have we heard about the term middle users? No. So this is not a user of financial statement. So option number C is correct here. Then, which of following is not a qualitative feature of accounting? Reliability. When we prepare our, when we do accounting, do we want to make sure that our records are reliable? Yes. And they should be relevant, right? Relevant in the term. If I'm looking at records of year 2024 and 2025, then I should only see the transaction relevant to this particular period. So transactions should be relevant. This is also true. Then are my financials comparable? Are they prepared using the same rules that I used last year? Yes. So that I can easily compare previous years, right? So they should be comparable. However, quantity. Quantity is not a feature in accounting that we use, right? So this is not the correct answer. I mean, so option D is not a qualitative feature of accounting. Question number 12. Which of these statement is correct regarding financial accounting? Number 1. It involves the recording, summarizing, and reporting of financial transaction of business entity. True. It focuses on preparation and reporting of financial statement for external users. It provides an overview of company's financial performance and position. It focuses on measuring and communicating the organization's social, environmental, and ethical performance. Now, read carefully what we are talking about. We are talking about financial accounting. So when we say financial, we are only talking about monetary item. We are not talking about the impact we are making on society, environment, on ethical performance. We do report this thing, and it is called ESG reporting, but this is a completely different practice, right? It does not fall under financial accounting. In financial accounting, we record, summarize, and report. We prepare financial statement. We get overview of our financial performance and position, but we do not measure or communicate the social, environment, or ethical performance. So option number D is not correct. So these three statements are correct, and this is our correct answer. Now, question number 13. Management accounting involves the preparation and presentation of accounting information for internal use by management, used for. Okay, in management accounting, we prepare the information for internal use of management. And what are they going to use it for? For planning, decision making, budgeting, or all of the above. Now, any management in a company is going to plan like what future actions we are going to take, how much we are going to spend, Planning involves budgeting, and then they take future decisions. Should we make investment or should we sell our investment, right? These kind of decisions we and what is going to be the basis of these all decisions are past financial performance. So we can see how much we have, how well did we perform with our past decisions, right? So all of the above is the correct answer. All these things are done with the help of accounting information. Now, question 14. What are the functions of cost accounting? So, first of all, what is cost accounting? Especially it is used in businesses which are into manufacturing or product businesses rather than service business. Okay. So, in cost accounting, what we do, we record and analyze what? We record and analyze the cost that is spent on our actions, right? Whatever uh, whatever business the company is into, to perform that business well, what costs are being used, or if I'm selling product A, what is the cost I have to incur to manufacture product A, right? That is done in cost accounting. So what are the functions of cost accounting? Number one, assigning expenses to products, departments, or activities to determine their individual cost. Monitoring and managing costs to ensure they stay within the planned budgets and targets. Examining cost behavior patterns and trends to aid decision making and process improvement. Or all of the above. Now, option number one. In cost accounting, we see how much cost a particular department, how much cost did we have to incur on a particular department, on a particular product, so that we can properly determine their sales price, right? So option number one is correct. Then the other purpose of recording and monitoring cost is that if I've made a budget, then I should be able to see that I stay within the budgeted cost. I do not overspend, right? So that is also a purpose of cost accounting. Then examining cost behavior to aid decision making. Like if in the previous year I produced 10,000 units of a particular product and I needed X amount of money, then if this year I'm going to target making 15,000 units, then I should know how much will I have to spend, how much will I need to be able to produce 15,000 units, right? So examining the past cost behavior, past patterns, past records of the cost, we can take our future decisions. So all these three options are used as functions of cost accounting. Okay. Let's look into question number 15. What involves identification of financial transaction? Okay, number one, identification. Then measurement of financial transaction, recording these transaction in books, classifying these transaction into a journal. So all these steps are related to what? These are related to our accounting process. So what is this? What involves? Accounting involves identification, measurement, recording, and classifying of financial transaction. Okay. So this is the correct answer. Question number 16. Which system is based on the idea that every financial transaction affect at least two accounts with equal and opposite effect? What system is this? This is called the double entry system, which is the basis of our accounting. Now question 17. Which fundamental concept forms the basis of double entry system in bookkeeping? So, single entry transaction, dual aspect concept, single aspect concept, or expense and revenue concept. Which fundamental concept is used in double entry system? So it is the dual aspect concept, that every transaction affects two things. Um, Either it can be asset, expense, drawings, or it can be our income, liability, or our capital, right? each and every financial transaction is going to affect these six accounts, and these will either increase or decrease, and but every transaction will have two effects. So that is the basic concept behind double entry system in bookkeeping. Now next question we have, which of the following best describe accounting standards? So first, recommendations that company may consider for ethical accounting practices. Mandatory guidelines for preparing and presenting financial statement. Voluntary principle for optimizing financial principle performance, or all of the above. Now, first of all, accounting is after fact process. Now, what does after the fact process means? We have made the sale, we have made the expenses, and then we are just recording it. Okay, the transaction has happened historically and we are recording it. Okay, so one of the things that means it, we cannot affect or optimize the financial performance with accounting. We can only present it, we cannot change it. So this option is outrightly rejected, because accounting presents the financial performance, but we cannot change the performance with the accounting. Okay, then mandatory guideline for preparing and presenting financial statements, or recommendations that company may consider for ethical accounting practices. Recommendations are something that I can recommend you while you're studying. You should take notes. This is something I recommend. On the other hand, mandatory guidelines are something like, if you want to get this job, then you have this particular certification. That is a mandatory guideline. So accounting standards are applied by law, right? Companies Act tell us that every company should follow accounting standard. So when a law tells us to do something, that is not recommendation, that is a mandatory guideline that we have to follow. So out of these two options, option B is correct, because these are mandatory guidelines. Okay. Question number 19. What happens if a company fails to adhere to relevant accounting standards? So if a company fails to adhere to relevant accounting standard, option number one, the company is immediately shut down by regulatory authorities. The company is exempt from taxation. Company may face legal and regulatory consequences, including fines, or the company's competitors are required to adopt the same practice. So, option number C, that if we are not abiding by the law, then we will have to face legal and regulatory consequences, and we also may have to pay the fines. Now, question 20. Which of the following is not a primary objective of accounting standard? Enhancing comparability of financial statement. That is correct. When all the companies follow the same accounting rules, then their financial statements are easily comparable with each other, because they are preparing financial statement using the same rules. Improving transparency in financial reporting. That is also correct, because accounting standards, they tell us to prepare notes to accounts, where we have to properly explain which accounting policy we are using, how we are calculating the amount. So it improves the transparency in the reporting. Increasing reliability of financial information. So definitely, when when the investors or the stakeholders, they are assured that the financial statement, the financial information that they are receiving is based on the rules that are implemented by law, then definitely the reliability of the financial information goes up. Okay, so these are all objective of accounting standard. Then automatically this option becomes our incorrect option, but we will still see why this is incorrect. Providing guidance on ethical business practices. Now, again, accounting is not something that is going to improve your business, that is going to improve your profit. No, it is just recording of fact. Financial transactions fact we are recording. That's it. So we cannot provide guidance on business practices. We are just recording the financial transactions. Question 21. Your company's subsidiary in country A is required to prepare financial statement following the local accounting standards. These standards are prescribed by which entity? So, your company, let's just say I have a company XYZ and I have a subsidiary in country A, okay, and they have to prepare financial statement by using local accounting standard. Local accounting standard to what? Country A. So definitely, who will prescribe these accounting standard? Government of country A, right? Question number 22. Your team is discussing the formulation and issuance of accounting standards in India. Which organization is primarily responsible for issuing and formulating accounting standard in India? So in India, which organization is responsible for issuing and formulating the accounting standards? So there are two organizations. Firstly, we have ICAI, Institute of Chartered Accountant of India, and Accounting Standard Board, the ASB. So these two accounting bodies are responsible for formulating and issuing the accounting standards in India. Okay, so question number 23 is talking about India. So there was a little typing error here. We had to write Ind AS 1. So option number, so these are basically, if you have remembered the list of Indias, which I would say is not extremely important for you to remember, but there are some basic Indias that you can remember easily. That number one is always related to accounting principle and disclosure, two is related to inventory, and seven is related to cash flow. Now in AS, we have AS3 that is related to cash flow statement, but in India's 7 talks about cash flow statement, and in AS4, there is no in AS4, but however, we have AS4 that talk about fixed assets. So out of these four options, first three are correct. Okay. So we sorry, our correct options are first three. So option 1, 2, and 3 are correct. Now let's move on to the next question. Question number 24. Your team is working on an asset management project and you need to determine the appropriate accounting standard. Which accounting standards specifically deal with accounting for fixed asset and its depreciation? So in accounting standard, the AS that deals with fixed asset and their depreciation is AS 10. Okay, property, plant, and equipment. Now, question number 25. A client is asking about the accounting standard that pertains to the accounting for intangible assets. Which accounting standard you should refer to? So, accounting standard 26 talks about what? Intangible assets. Now, question 26. Which of these combination is correct regarding Ind AS? We have AS 13 accounting for investment, AS 14. So rather than saying Ind AS, this is for AS. Okay. Now, let's just see. Which of these combinations is correct regarding AS? AS 13 accounting for inventories, AS 14 accounting for amalgamation, AS 19 is for leases, and AS 20 is for earning per share. So all of these options are correct because these are right AS that are referred here. Okay. Now, question 27. What does GAAP in accounting stands for? So GAAP, what does GAAP mean? Generally accepted accounting principle. So option number C. Question 28. Which of these statement is not correct regarding GAAP? GAAP is a global set of standardized guidelines that dictate how financial statements are prepared and presented. GAAP ensures consistency, comparability, and transparency in financial reporting for businesses and organizations. These principles covers various aspects of accounting including revenue recognition, expense recording, and asset valuation, or none of the above. So, in generally accepted accounting principles, which of these is not correct? So GAAP do provide us standardized guidelines that all businesses should follow. When all businesses follow standardized guideline, what is the result? The financial statements are A, consistent, B, comparable, and C, transparent. So option number A and B are correct. Then number 3. In GAAP, what aspects are covered? We cover accounting. In an accounting, we cover how should we recognize the revenue, how should we report our expenses. So these things are covered. So none of these option is incorrect. So option number D is going to be the right answer here. Question 29. The primary body responsible for establishing GAAP in the United States are SEC, the Security and Exchange Commission, American Institution of CPA, Financial Accounting Standard Board. So first of all, in United States they follow US GAAP. Like in India we follow AS and Ind AS, right? So United States is quite different. They follow their own path and they follow US GAAP only. They don't even follow IFRS. Okay. So, like in India, we have Security Exchange Board of India. They have SEC. In India, we have Institution of Chartered Accountants of India. They have CPAs. So that is conducted by a body called American Institution of Certified Public Accountants. They are like chartered accountants we have here. Okay. Then in India, we have Accounting Standards Board. In United States, they have Financial Accounting Standard Board, FASB. So the functions are kind of similar, just the names are different. So these are the three bodies that are responsible for establishing GAAP in the United States. Okay. Now, what does the IFRS stands for? So when we started this chapter, I told you its meaning that IFRS means International Financial Reporting Standards. So it's not finance reporting standard, it's financial reporting standards. And it's not Indian financial reporting. Okay, don't confuse I for Indian because IFRS are internationally recognized accounting standards. Question 31. Which of these statements correctly represent IFRS? Now, IFRS is a global set of accounting principles aimed at standardizing financial reporting. True. IFRS is developed by International Accounting Standard Board. That is also correct. Like in India, we have ASB and ICAI who sets the accounting standards. Globally, there is a body called IASB, inspired from whom we had ASB in India. Okay, so they developed the International Financial Reporting Standard. And option number 3, IFRS adoption facilitate easier cross-border investment and business transaction due to consistent reporting standard. That is correct because when India adopted IFRS, so in India, IFRS were adopted in 2016 after Modi government came because their goal was to bring foreign portfolio investment. They wanted to increase foreign investment in India, and for that purpose, they wanted to ensure that the companies in India are preparing financial statements that are matching the global accounting levels, that are matching the global accounting standards, so that people from foreign countries can easily read our financials. And how will they be able to read our financials when we are following the same set of rules that they are following? That's why IFRS were prepared. So global trade can be done easily. So all these three statements are absolutely correct. So option number D is going to be the answer here. Now we have question number 32. Which of the following statements is not correct regarding the formation of IFRS? So we talked about why the IFRS were formulated. So we have to tell them which of these statements is incorrect. Okay. So IFRS said the original name of International Accounting Standards. So that is true. So firstly, internationally there were accounting standards that were called IAS, okay, and they were following the same purpose, that we want to give same set of rules for global accounting, so the international investments and foreign investments can be made easily. But as times changed, there were robust changes in the financial transaction due to technology. There were so many new financial transactions coming that were not considered earlier. I will give you one example. With the coming of e-commerce, okay, we didn't have to record much about free coupons before. We didn't have to record much about gifts or digital currency or things like that. Okay, so with the changing times, we saw that our accounting is becoming stale. We need to change it as per the current business trend. So that's why they decided to change the international accounting standard to IFRS. So currently, two set of accounting rules are going on, IAS and IFRS both. So some of the IAS are converged into IFRS, but others are still continuing as it is. Okay. So this is correct. IFRS had an original name of International Accounting Standard. Option 2. IAS were issued between 1973 and 2001 by Board of the International Accounting Standard Committee. So this is correct. Then, um, on April 2001, the new Accounting Standard Board took over from IASC the responsibility for setting international accounting standard. That is also correct. Okay. However, the option number D, IASB rejected existing IAS and developed standard calling IFRS, is not entirely correct. Okay, because they are not completely rejected. There are still IAS that are prevalent globally, but we are changing the IAS that needed. In which areas we had to make huge changes, and one of the example of this is on accounting standard on financial instrument. Okay, so previously we had a accounting standard called investments. Okay, so in that we used to talk about how we will record investment, but as we saw, there were so many new transactions, so many new type of transaction coming in investment. Stock options were being issued and different kind of new options were given, like people used to pay in terms of stock, right? So we needed to figure out how to record this transaction. That's why they came up with an accounting standard called financial instrument. So they did not reject the complete IAS, but they did change some of them. Okay, so this option is not correct. Question 33. Your MNC engages in transactions between its various entity located in different country. So we have an MNC and it is operating in different countries, and it is making transactions with various entities. Okay, now what is the term used to describe pricing of goods and services or intangible asset transfer between related entities? So in accounting or in financial terms, when two related entities are selling goods to each other, the price that is used is not called the selling price, because if let's just say related entities are like family. Okay, so the parent entity we can call that as parent. Okay, and the subsidiary we can call it as son or daughter, right? So when a parent gives food to their son. Food means food for a company can be its raw material, right? So if a parent is providing raw material to its subsidiary, it is not selling the material, it is just transferring. So that's why we can't say it is sales price, we will call it transfer pricing, because when the parent is going to sell to its subsidiary, it is not going to sell for making profit, right? So that's why the term that we use here is called transfer pricing, and they will only charge that much with which they can cover their cost of producing the good. Now, then we have arm's length price. So, before going into the option, we just simply understand what is arm's length price, and this is mainly used in the concept of transfer pricing. Okay, so arm's length price is when we are talking about related parties, the term that we use is transfer pricing, the price at which they transfer. But when the two parties are unrelated, okay, I am just making a simple business transaction with the unrelated person, and the price at which I will sell to that unrelated entity is my arm's length price, because I only care about my profit when I'm dealing with unrelated person. Okay, so arm's length price is the price at which I will sell to a normal customer to an unrelated entity. So the correct option is arm's length price is not set by government. Okay, and it is definitely not the price that is used by related parties, because that is called transfer price. And this is transfer price to its most valued customer. Now, see, when we say most valued customers, now in there also we we do give them some sort of favor. We may provide them preferential pricing, we may charge less from them, or we may provide more discounts to them. Okay, so that is also not called arm's length price. The arm's length price is called that we sell to a normal customer to an unrelated party. So option number C. Now question 35. Which international organization provide guidelines and recommendation on transfer pricing practices, offering guidance on applying the arm's length principle and transfer pricing methodology? So, which of these organization is dealing with the transfer pricing methodology? And it is called our OECD, Organization for Economic Cooperation and Development. Question 36. If a multinational company sells product to its subsidiary, the price is compared to similar sales made by unrelated company in comparable market condition. This statement represents which method of transfer pricing? So, when we are calculating the transfer price, there are different techniques through which we can calculate the transfer price, and one of those methods is called, what we do, if I am going to sell product A to my subsidiary, I will see if their conditions were exactly similar. How much will I charge if I sold this product to a completely unrelated party? Okay, so whatever the price that is, that is the price that I'm going to use to calculate the transfer price. Okay, so this method is called comparable uncontrolled price cup method. Okay, so option number A is correct. Now question 37. Which of the following is a transfer pricing method used if a parent company provides manufacturing services to its subsidiary? It can charge the actual cost plus a predetermined profit margin. Now another condition on another method of charging or calculating transfer prices, that the parent is selling raw material to its subsidiary, and this raw material is the main source of manufacturing the product for its subsidiary. Like, let's just say the subsidiary purchases 90% of its raw material from the parent. Okay, so in this case, the the price that is going to be calculated as actual cost that the parent incurred plus some sort of margin. They can choose 10%, 20%, and whatever they wish. Okay, so this is called cost plus method, because see, the name clearly defines, we take the cost and we plus the margin in it. Cost plus method. Okay, now last question in this chapter that we have to see is, your MNC has subsidiaries in different countries, each contributing to the overall profitability. Which transfer pricing method allocate profit based on contribution of each entity to the MNC's profitability? Now, in this method of calculating transfer price, what we are going to see, we are going to calculate the transfer price based on the profit they have contributed to the MNC. So again, you can see the name and see which is the most relevant name. So we are taking profit and we are splitting it. So the profit split method is what we are going to use in this case. Okay, so that was it for your chapter number 1, and I hope that I could explain you in as much detail as was possible. And if you feel that I could explain you in a better way, or if you prefer something else, then do let me know in the comments. Or if you like this video, then please like, share, and subscribe this video. And if you want to purchase or enroll in the JIIB course, then the early bird course is going on, then you should quickly enroll in it and take benefit to clear the exam in just 15 days. You can visit our app to check out the course, or you can telegram us, or we can use the link that we put in the description. And I will see you in other lectures. Till then, happy learning. Bye bye.